Hello everybody, this is Professor Lambert in Business Valuation of Privately Held Companies, lesson number 2. The first thing we're going to discuss today are the items that you need to perform a valuation. And these are the questions that you should be asking your client when your phone rings and they tell you they need a business valuation. You should be asking for these particular items. And I've made an acronym or mnemonic to help you remember these things, and it's called divots. Now, if you play golf, you know what a divot is. It's that big patch of grass that gets created when you swing the golf club and hit down on the ball. You can see some pictures of them on the right. Divots actually stands for the things you need. So the first thing is D and V, the date of the valuation. Whenever you're doing a valuation, you're doing it as of a specific date, and you cannot use any information that was available after that particular date. Even if you're doing a valuation from the past, you have to go back to that particular date and time and prevent yourself from looking at any additional information. The I in divots is the interest being valued, and you want to be as specific as possible. If someone says, I want you to value my company, that's just not enough information to help you determine what you need to do. You need to ask specifically, what class of equity am I valuing, preferred or common? And then how many shares in particular, so you know whether that's a controlling interest or a non-controlling interest, and we'll talk more about that later. You need to know the objective. What is the purpose of this valuation? Why does the person need it? Because when you do a valuation, the valuation is only good for that one individual purpose. So for instance, if you were valuing a company for estate taxes, so somebody passed away, an owner passed away, and then the company said, well, we're going to sell the business and we're going to use your valuation to sell the business. Well, you can't do that. It's not necessarily the same conclusion of value. So the objective is very important. Timing is also important from a client service standpoint. When does the client need your valuation report? Do they have a hard filing deadline, or is it just something they would like as soon as possible? So certain things related to trust and estate or gifting or estate tax valuations, when someone dies, their estate tax return is due 9 months from their date of death. So of course, this can happen at any point in the year that somebody passes away. So the valuation date for an estate is always very specific to when that person passed away. If somebody makes a gift during the year, that valuation, the gift tax is due on April 15th of the following year. So that's one that follows similar to the income tax return timeline. Gift taxes follow that same timeline. So the timing of when your client needs their report is very important. Finally, the standard of value. Which standard will govern the valuation? Is it a fair market value valuation? Is it a fair value valuation? And remember that those are two very distinct items. You also want to know the premise of value. Is this going to be on a going concern basis or a liquidation basis? Most of your valuations are going to be done on a going concern basis, 99.9%. So these are the things you need to know before you start the valuation engagement. Let's talk about valuation in general and what it takes into account. So in other words, to value something, a financial asset like common stock of a company or preferred stock or even another asset like that generates any income like a royalty stream. The question is always, well, how do you come up with a value? The very first thing we're going to talk about is valuation as a function of expected future benefits. What that means is, if you're asking me what I would pay for something today, my answer depends on what I'm going to receive in the future. So just like we've discussed in prior classes about present value, if you tell me you'll pay me $1 in the future, then I can tell you what I would value that at today. If you're going to pay me $1 in 1 year, I might tell you, okay, I'd pay 90 cents today to receive $1 in 1 year from now. There also is a function of risk. The higher the risk associated with an investment, the higher the investment return needs to be. And so if you told me that you have a startup company, some new internet app that has zero revenue and you just have all expenses because you're in the development phase, that's a much riskier investment for me than if you told me your business makes $2 million of sales revenue and you have $500,000 of net income. So in other words, you already have a revenue stream, you're already generating net income. That's a much less risky proposition than a startup company that has no revenue. And there's quite a spectrum of risk related to investments. There are three broad methods that we'll talk about. This is now on the third bullet point, the income, market, and asset approaches, and we'll go into more detail on each of those in a future lesson. But basically, the income approach says that the value of an asset is a function of the income it's expected to generate. The market approach says the value of an asset is the value or very similar to all the market data that shows similar assets being priced. So I'll give you an example of this. If you were to buy something on eBay, the auction marketplace, and let's just pick a piece of sporting equipment as an example, a golf club. If you were to buy a golf club on eBay, you can look at what other market transactions have already occurred with that same type of golf club. So you might find 5 of those similar types of golf clubs sold in the last few months. The average sale price was $100, so therefore you think the market value of the one you're bidding on is $100. And finally, the asset approach looks at the value of a business as a collection of discrete assets. So if you took the balance sheet of a company where you have cash, accounts receivable, land, building, equipment, and instead of using historical accounting measures for those assets, you adjusted them to their market values, and then you subtracted off liabilities, that might give you a reasonable idea of value from an asset approach. Now we're going to talk in a lot more detail. That's a really oversimplified version of those three methods, and we're going to talk in a lot more detail in class on some of the very nuanced aspects of each one of those approaches. The next thing that's important in valuation is the level of value. Are you valuing a controlling interest, a non-controlling interest, which is sometimes also called minority interest? And is it a marketable value versus non-marketable? And again, we're going to go much deeper into these topics, but just think about something. If I offered you a choice and said, I'll let you acquire 51% of the common stock of this company or 49% of the common stock of this company, which would you prefer? Most people tend to say 51%. Why? Because they want control. When it comes time to vote on a matter for the company, the 51% interest will always get their way. The 49% interest might get their way unless the 51% interest votes the opposite way. And there's a lot of nuance and detail within that as well. But that's the idea of control versus non-control. And they have different values. The marketable versus non-marketable has to do with how quickly can you turn your investment in a business into cash. How quickly can you sell it and get cash for that interest? Well, if anyone here has invested in publicly traded companies, you know that if you decide to sell a stock that you own, your cash is in your account within 2 to 3 days. So if I owned shares of Tesla or Starbucks or some other publicly traded company, I can look at the market price, I can place a sell order, and I know within minutes what price I sold that at, and my cash shows up in my account in 2 days. If I own a privately held business, a gas station, a grocery store, any privately held business, it takes a long time to convert that business into cash. When you sell a privately held business, there is no stock market giving you a regular quoted price on the value of that asset. So you have to find a potential buyer. You have to provide them with your financial data. You have to let them examine your company and find out everything they can about it. And that's called due diligence, where somebody will investigate your company and learn as much as they can related to value. So publicly traded companies are fully marketable. You get your cash in 2 to 3 days. Privately held businesses and family businesses that are not publicly traded are non-marketable. It takes a lot of time to get your cash. And finally, if there are any restrictions on transferring a piece of equity, a stock interest in a company, that can affect value as well, and we'll get into that more in the future. When you do a due diligence, what things are you going to ask for as a business appraiser? The very first thing you're going to want to have is 5 years of financial data. So the prior 5 years of history will be the first thing you ask for. Now, not every company has an audit, especially privately held businesses. Most of them do not have audits. They might have tax returns. Some might have a compilation. Some might have a review. And again, very few would have audits. And if you don't know what those terms are, we'll have a discussion in class to refresh on the level of assurance that each one of those items provides, those different types of financial data. You'll also want to ask for projections. Does the company project any results either 1 year out as a 1 year budget or beyond that? Some companies do a 5-year projection. And as an appraiser, you want to look at a projection until the company reaches a steady state of growth. You're going to want to visit a company and interview management and get a tour of the facilities. You want to find out what type of entity they are. Are they a C Corp, an S Corp, an LLC, a partnership, or even a sole proprietorship perhaps? And you want to look at the corporate governance documents depending on what type of entity it is. And we'll go into more detail in class what those distinctions are. You'll do some financial analysis in a lot of detail. You'll want to know about the ownership structure of the company. What are the different classes of ownership or equity? Who owns what? How many owners are there? What percentage does each one own? You're going to want to know if there are any litigation issues associated with that company. You're going to want to look at the board minutes, which are the notes when the board of directors of a company meets. The secretary takes those notes, and that secretary is usually has a law background. That's usually a lawyer. And then the ultimate question you'll be asking when you do a due diligence on a company is there anything that I haven't asked that is relevant to the valuation? This is a catch-all type of question where we ask management, hey, what else do you think we should know? And we're looking for management to provide any additional information. And we're going to document what they say. And if they say there's nothing else that we should know, we're going to document that as well in case something crops up down the road. So anyway, that's our end of this lesson 2. Hope this proved useful. And again, we're going to discuss more of these things in detail in class.